So for Forex and 5 this week in developed markets, all eyes are still on the US, looking at their inflation data. Now, inflation is probably running a bit hotter than what a lot of people would have expected with the higher interest rate environment post-COVID. But there seems to still be rates priced in for the rate cuts priced in for the rest of the year. What was 3 cuts has now become 1 to 2 cuts. Certainly the Fed and the FOMC in their recent meeting have sort of followed along this line. There were some questions around would rate hikes be on the horizon to control inflation. I don't think we're quite at that stage yet, but it's certainly been tempered. The sort of like the dovish chatter among the Fed has certainly been pared back. But we'll see what comes up in the next few weeks. If we see job data turning quickly, then that could lead to a knee-jerk reaction from the Fed to actually cut a little bit more. In Europe, however, they seem to be well along the dovish cycle. We might start seeing cuts even as early as June. In the UK, similarly, September seems to be the time we're thinking there's going to be a cut, but again, that could come earlier as well. It's a bit of a different environment. Everyone thought the US was going to lead, but now suddenly the US is running way hotter than expected, whereas Europe and the UK are seeing inflation drop a bit quicker. So it's making for a stronger dollar, weaker G3, but we'll see what transpires over the next couple of weeks. Over in Nigeria, so inflation's printing pretty high at the moment. We're seeing around 33% year on year. This is pretty near certainly the recent highs, so perhaps cause for concern. Naturally, the exchange rate where it is at the moment, sort of like 1300s, 1400s, isn't helping, but whether the CBN will choose to combat this with more rate hikes, more tightening of the monetary policy remains to be seen. They've got more sort of tools in their arsenal potentially on monetary policy other than just rate hikes to try and control inflation, but these recent inflation prints may have been reflective of when the rate was getting close to 2,000 on parallel bits. That's sort of pared back a bit. There's a bit of concern around reserves at the moment. Reserves dropped around 5% recently, and when the CBN's already running pretty low on dollars at the best of times, we really don't want to see these numbers dropping any lower. The CBN are pretty convinced, or they're certainly preaching the narrative that they're not using up dollars to try and control the exchange rate. There's been quite a few tactics still, like selling small amounts of dollars at lower rates to try and control the exchange rate a bit. The turnover in the official window has been a little bit disappointing, so I think more needs to be done now again to sort of like fuel the emphasis on trading in the official window, pulling away from the parallel and getting the exchange rate overall under control and get it moving back towards 1,000, which is ultimately the goal currently at the moment. Over in Kenya, inflation's actually been cooling off quite a bit. It's a bit more than expected, so that's a pretty good sign for the exchange rate. Naturally, with the drop from sort of like the 150, 160 levels down to 130 in Kenyan shilling, this has definitely helped. However, the recent tragic events with flooding in Kenya might cause a knock-on effect, first of all, to the crop market. If there's a massive shortage of crops in the coming months or when the harvest comes around, we could start seeing a spike in inflation again, and then perhaps we might see the shilling react accordingly. But at the moment, the banks are still offering dollars quite freely, so we might see a nice bit of pressure to keep the Kenyan shilling rate down a bit closer to those sort of 130 levels. There has been a bit of talk around President Ruto asking for the World Bank to be pledging more dollars that they did back in 2021. Perhaps this might be wishful thinking, to be honest, from his side, but it's worth putting your hat in the ring, as it were, to try and get more dollars in country. Bonds overall across the whole of Africa seems to be the talk of the town at the moment. Clearly Kenya, Mali, Ivory Coast, a few others are issuing eurobonds, Nigeria being another. It's been quite interesting to see in the secondary market there's been a lot of activity for people to be buying up the existing eurobonds that are in the secondary market ahead of any eurobond issuance potentially in June. We would have expected that people would hold fire with their dollars, waiting for the new issuance, trying to get those strong yields on a new eurobond. However, it seems that the yields in the secondary market were too good to be true, so there was a bit of a bid for dollars to buy up those bonds, but we'll see what happens when the new issue comes out, if it does come out at all. Finally, just in Zaf and Zoff, the cocoa market has been pretty disappointing. it's not clear how much an effect it's going to take across the whole of West Africa, but in ZAF and ZOF there certainly will be some pressure on the currency to perhaps move higher. We're seeing ZOF pretty close to the peg at the moment, which is quite interesting, but it may not stay there for too much longer, but naturally we'll be keeping tabs.